Hey guys, welcome to this explainer session. If you're a BS accountancy student staring down the barrel of the LECPA, you already know the deal. The Philippine taxation exams are just brutally difficult. The sheer volume of rules, exceptions, and rates, yeah, it's enough to overwhelm literally anyone. But today, we're not just memorizing, we are hacking your brain. This explainer is designed specifically for you, Gen Z board exam warriors. We're going to build cognitive frameworks for 3-year memory retention. That means the tax concepts we lock in today are going to sit right there in your mind, totally ready to be retrieved when you actually sit for the boards in your second or third year. All right, here's the mental schema we're building today. 1. Mastering LCPA capital gains. 2. Real property, the 6% rule. 3. The Principal Residence Exemption. 4. Taxing shares, traded versus unlisted. 5. DST basics. And 6. Bullet review and study hacks. Okay, let's jump straight into Section 1, Mastering LCPA Capital Gains. Section 2, Real Property, the 6% Rule. Okay, let's dive into this. We are officially ditching those dense black and white textbooks today to build clean, high-contrast mental anchors. So let's open up our first major mental folder, Real Property. Specifically, we're looking at capital assets in the form of land and buildings located right here in the Philippines. Remember, if the property is used in an active business or subject to depreciation, it's an ordinary asset. But if it's held as an investment or a personal asset, it goes right into this folder. Now I want you to visually burn this number into your mind, 6%. This is the golden rule. It's the absolute anchor for real property capital gains tax in the Philippines. Whenever you see a board exam question about selling a parcel of idle land or a vacation home, your brain should immediately flash the 6% sign. Now, you might be wondering, what exactly do we multiply that 6% by? Well, the brain learns incredibly well by contrast. You've got to compare the gross selling price against the fair market value. And here's the absolute crucial rule. You always apply the 6% to whichever of these two numbers is higher. The BIR actually calls this a presumed gain. Crazy, right? This means even if you sell the property at a massive loss compared to what you originally bought it for, the BIR just presumes you made a gain based on the selling price or the market value. No matter what, you still pay that 6%. Let's dig just a little deeper into that fair market value side of the equation, because honestly, the exam loves to test this. The FMV isn't just some random guess. The law defines it super strictly. You have to compare the BIR commissioner's zonal value against the provincial or city assessor's schedule of values. And again, the rule of higher applies here too. FMV is always the higher of these two values. So, you find the highest number between the zonal value and the assessor's value, and then compare that winning number to the gross selling price. The highest of them all gets slapped at the 6%. Simple as that. Section 3, the Principal Residence Exemption. Now, what's really interesting here is that every golden rule has a golden exception. Welcome to the biggest LECPA trap, the exception to the 6% rule. If you sell your principal residence, the actual home where you and your family live, you might just escape that 6% tax. But trust me, the BIR doesn't make it easy. You have to treat this exemptions checklist as a rigid, non-negotiable survival guide. Missing even one requirement means you pay the tax. First, you've got to fully utilize the proceeds to acquire or build a new home within 18 months. Second, you can't just promise to do it. You literally have to deposit the presumed 6% CGT in a bank escrow account right away. Third, you must notify the BIR with a sworn declaration within 30 days of the sale. And finally, you can only pull this trick once every 10 years. Let's create a really strong visual anchor for that 18-month reglementary period. 18 months, a year and a half. This is your ticking clock. If that 18th month passes and you haven't fully used the money to build or buy your new principal residence, well, that escrow account gets cracked open, the BIR takes the tax, and you lose the exemption completely. But hey, what happens if you only use some of the money? Let's say you sell your old house for $4 million, but your new house only costs $3 million. You've got $1 million unutilized. The math logic here is actually pretty simple. You just create a fraction. Take the unutilized portion and divide it by the gross selling price. Then multiply that fraction by the full 6% CGT you would have originally paid. Boom, that gives you the exact taxable portion you owe the BIR. And this brilliantly illustrates an elegant, if slightly terrifying piece of tax math, showing how the code maintains total balance. If you only partially utilize the proceeds, your new home's tax basis actually changes. You use a similar fraction. Take the utilized portion, divide it by the gross selling price, but this time, multiply it by the historical cost of your old residence. This neatly carries your old cost basis over to your new home, mathematically adjusted for the fact that you didn't reinvest everything. Moving on to Section 4, taxing shares, traded versus unlisted. All right, take a deep breath. We are shifting your mental gears now to the second half of this explainer, domestic shares of stock. Forget the 6% rule for a second. We're opening a completely different mental folder now. Since our brains absolutely love tables for quick memorization, let's contrast the two distinct environments for selling shares. If you sell shares that are listed and traded through the local stock exchange, you don't pay income tax. Instead, you pay a stock transaction tax, or STT. That's a tiny 0.1% based on the gross selling price. But, and this is a big but, if you sell unlisted shares directly to a buyer off the exchange, you get hit with capital gains tax at a pretty hefty rate based on your actual net capital gain. Really focus in on this number for unlisted shares, 15%. Under the CREATE law, the rate for selling off-exchange domestic shares is a flat 15% on the net capital gain. Notice the huge difference here? Real property was 6% on the gross selling price, or FMV. Unlisted shares are 15%, but only on the net gain, meaning your selling price minus your actual cost. Now watch out for this sneaky board exam twist, the minimum public ownership, or MPO trap. A company might technically be publicly listed, but if their public float drops below the mandatory 10% minimum, they're officially non-compliant. If you sell shares of a non-compliant publicly listed company, you don't get that nice low STT. Nope. Instead, you get slapped with the brutal 15% capital gains tax, exactly as if the shares were unlisted. Always check for MPO compliance in those word problems. Section 5, Documentary Stamp Tax Basics. Just to complete your understanding of the whole transaction cycle, we need to briefly talk about DST, or Documentary Stamp Tax. Think of it as the silent tax that rides alongside these transactions. Here is the hard-hitting rule for DST. It applies to real property transfers and unlisted share transfers. However, if you sell listed and traded shares through the local stock exchange, you are totally exempt from DST. And here is a critical warning for the LCPA. Even if you perfectly execute the Principal Residence Exemption and owe absolutely zero capital gains tax on your house, you are still liable to pay the documentary stamp tax. Yep, there is no Principal Residence Exemption for DST.
All right, Section 6, Bullet Review and Study Hacks.
Let's move to active recall and see how this builds into your long-term memory. Don't just listen. Try to anticipate the words before I even say them. This struggle is exactly how you cement the knowledge. Ready? Rapid fire. Real property CGT, 6% on the hire of GSP or FMV. Unlisted shares, 15% capital gains tax on the net gains. Traded shares on the exchange, a tiny 0.1% stock transaction tax on the gross selling price. And what's that critical window to replace your principal residence? Exactly 18 months. Okay, let's test those mental folders with a tricky scenario you will absolutely see on the exam. What happens if an individual sells unlisted domestic shares directly to a friend, but they sell them at a loss? Think about it for a second. Access the shares folder, not the real property folder. The answer is no gain, no CGT. Remember the contrast we built earlier? Real property taxes you on presumed gain based on selling price or FMV. So you pay 6% even at a loss. But unlisted shares are taxed at 15% on net capital gains. If your cost is higher than your selling price, your net gain is 0, and 15% of 0 is 0. You owe no capital gains tax. Before we wrap, I want to share this quote directly from the CPA review materials. Our finite mind needs the guidance of God's infinite mind. Studying for the LECPA is a grueling, exhausting marathon. When your brain feels like it literally can't absorb a single new tax rate, just take a breath, center yourself, and trust the process. You are building the capacity to succeed. So you know the core rules now. You possess these structured frameworks. You have the mental anchors for the 6% rule, the 18-month exemption, and the 15% share tax. The real challenge now is application. When the board exam twists the facts, throwing in a non-compliant MPO or a partial residence utilization, will your mental folders hold up? Keep practicing, keep testing your recall, and you will absolutely crush the LECPA. Thanks for hanging out in this explainer session. Happy studying!